Okay, good afternoon, everyone, and welcome to today's educational webinar. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay, and today we are going to be going over a very basic topic in understanding calls and puts. So this is very much, for someone who is brand new to options trading, but even if you have, traded options for some time, it's always good to get a rehash of the basics. So quite a lot to get through here today. And before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Just another disclaimer here. Options do involve significant risk and are not suitable for all investors. Certain requirements must be met to trade options. Before engaging in the purchase or sale of options, investors should understand the nature of and extent of their rights and obligations, and also be aware of the risks involved in investing with options. If you haven't already read the PDF that I sent in the chat window, please do so after the webinar. Okay, so our agenda for today. Starting off with a review of call and put basics, just going over the basic definitions of the two types of options. From there, we'll be moving on to a review of an options chain. We'll go and move on from there to long and short equity call options and long and short equity put options. So kind of comparing what the trade management of a long and a short equity call, and again, of an equity put, long and short. Finally, we'll have a summary section, and we'll end today's webinar with some Q&A. So going back to basics here, what is an option? And an option is simply a contract between a buyer and a seller. Buyers pay a premium and can execute on the terms or rights of the contract. Sellers are obligated to fulfill the terms of the contract itself. So on the left-hand side, we have an example of an option contract. We have 100 shares of ABC at $100 per share. This isn't actually what an option contract would look like, but this is exactly what it means, where you can buy or sell 100 shares of ABC at a certain price on a per share basis. This is executable at any time until the expiration date, for example, using July 7th. That should be 2023. And the buyer of an option will pay a premium to the option seller. So there are two different types of options, a call option and a put option. A call option simply contains the right to buy 100 shares of the underlying asset, and a put option simply contains the right to sell 100 shares of the underlying asset. So like any contract, options do have a bit of an anatomy. There are certain similarities with an option contract. So the first thing we are agreeing on is what quantity are we agreeing on, what product are we agreeing on, what price are we agreeing on, and what time frame we are agreeing on. In terms of the quantity, this is with reference to the contract amount. And remember, one contract always equals 100 shares. The product would be the underlying security itself. This could be a stock, ETP, index, currency, or even a commodity. What price are we agreeing on? This is with reference to the strike price. So the underlying shares or the underlying security would be purchased at the strike price or sold at the strike price. This is priced on a per share basis. And in terms of the time frame, this is simply the expiration date. All option contracts do have an expiration date. Normally, this is on Fridays. However, there are some exceptions. So what quantity are we agreeing on? For example, let's say, we're agreeing on one contract of stock ABC with a strike price of 100. And the expiration date is July 7th, for example, 21 days to expiration. You can just, the DTE stands for days to expiration. So we have 100 shares of ABC stock at $100 per share expiring on July 7th. But what does it actually mean? Well, there's two, like I said earlier, there's two different types of options: a call option, which contains the right to buy the underlying asset, and a put option, which contains the right to sell the underlying asset. So for call option, you could, if you bought a call option, you would have the right to purchase 100 shares of ABC stock at $100 per share at any time before July 7th. And for put option, you would have the right to sell 100 shares of ABC stock at $100 per share at any time before July 7th. Now, there's really three outcomes that can happen once you purchase an option. And the first outcome is that it could get exercised. So this is when the option holder executes on his or her right to follow the terms of the contract. So like I said, a call option allows you the right to buy, and a put option allows you the right to sell. The option could also expire worthless, and that's because, because there's a strike price. And if I bought a call option, if I'm an option buyer and, I want to execute on the rights of the contract itself, I can only really execute it when the price is above 100. That's the only time it makes sense, right? Because if I'm paying to purchase a call option, which allows me to purchase it at 100, it only makes sense for me to purchase these shares if the actual price of ABC stock is above 100. If it's below 100, and if I still wanted ABC stock, I wouldn't be purchasing it at 100 shares. I'd be purchasing it at the market price. So in that case, the call option would simply expire worthless. And this is the most common outcome that actually happens, and that is that the option is traded. So when you buy to open a call option, you can also sell to close that position. You're not locked into the trade up until July 7th. And most of the time, the option gets traded and eventually closed. So this simply has to do with the fact that options contain something that's known as premium. So premium is how much the option is worth, and that can fluctuate due to a number of factors. You have time to expiration, you have the implied volatility, you have the underlying security, the movement in the underlying security as well. There's a whole bunch of factors, even interest rates, that can impact an option premium. But the premium dictates what price the option will be traded at. Okay, so we have a basic T chart here of the four main strategies. We have long calls. This is the most common strategy that most of you would be familiar with. Long call simply means you buy a call option, and this is purchased for a premium. In this case, you own the right to purchase shares of the underlying assets. The short call is the opposite. This is sold for a premium. So the option seller is selling a call option or writes a call option to the option buyer. The option buyer pays a premium. The option seller receives a premium. In this case, the short call writer is obligated to sell 100 shares of the underlying to the long call holder. So whenever you look at a long call holder or even a long put holder, they are the drivers in the scenario, whereas a short call holder and a short put holder they're passengers. So when you sell options, you don't really control what the outcome is going to be. You don't really, or in other words, you don't control the exercise of the option. Only the buyer of the option can control the exercise of the option. So on the right-hand side, we have the put options. And a long call is bullish, a short call is bearish. And on the right-hand side, we have another bullish strategy here, which is short puts. Short puts is the opposite of a long put option. So a short put option is sold for premium to the long put buyer. And in this case, the writer who sold the put option is obligated to purchase 100 shares of the underlying from the long put holder. A long put is purchased for premium. That premium is given to the short put writer. And that premium is the option sellers to keep, by the way. In this case, the long put holder will own the right to sell 100 shares of the underlying to the short put buyer. So a long put is bearish. because it allows the holder to sell the shares at a higher price than what the current market could be trading at. That's why you want the price to move lower. And a long call, and of course, a short put is opposite of that, which is bullish, because you don't want to get assigned. And the only way to not get assigned is if the stock either stays neutral or continues to move higher, as long as it's above the strike price at expiration. That way you won't get assigned, and that is why the short put strategy is a bullish strategy, as if you don't get assigned, you simply keep all the premium that you received from the long put buyer. Okay, so over here we have a basic option chain. And at first glance, I always thought this is quite intimidating. There's a lot of numbers here, but it's actually quite simple. There's a lot of numbers because there's a lot of different options and with the different strike prices. However, don't be intimidated by this. So on the left-hand side, we have call options, and on the right-hand side, we have put options. And the middle, that's just different strike prices. So there will always be quite a number of strike prices, especially on something like the SPY, which is the S&P ETF for the S&P 500. That tends to have many different strike prices that tend to be quite liquid. So you tend to see, a fairly big options chain for SPY. But it doesn't mean all other names or individual stocks would have something like this. So we also have on the first trade platform, we also have the expiration dates at the top, and you can choose different expirations based on, your directional view for the SPY. So the last price is simply the last price traded. And the change is the difference between the last price that was traded and the previous close from the day before. The bid price is the best price available to sell, and obviously you have the ask price, which is the best price available to buy. In between this, you have something known as a mid price between the bid and the ask, and that is the theoretical best value you will get for either buying or selling that option. You have volume, which is simply the amount of contracts traded today. It does get a reset every day, but it gives a good indication as to the amount of interest in the trade by traders and investors on that particular day. And of course, you would have open interest, which is the amount of contracts in existence. So open interest reflects the number of contracts that are held by traders and investors in active positions ready to be traded. So both volume and open interest do give some indication as to how liquid the underlying security, how liquid the option is. It's not that simple. There's actually a lot more to liquidity than just simply the volume and open interest, but they do play a small part in that as well. Okay, so moving forward here, we have an example here of a long equity call option. So this is when you simply buy to open one XYZ call option expiring on July 7th at a strike price of $150 for $7. So there's quite a lot to take in here, right? But if we break it down, you're buying to open, so you buy a call option of stock XYZ. You're only buying one contract, which is the equivalent to 100 shares, and the expiration date is on July 7th. The strike price is $150, and you're paying $7 for this. Remember, this is on a per share basis, so you are paying $700 in total. This gives you the right to purchase 100 shares of XYZ for $150 per share at any time up until July 7th in exchange for a debit of $7 or $700 in total. Now, when it comes to the basic definitions, especially for like long equity calls and long equity puts, it always says the right to buy. And yes, that is theoretically correct. However, remember what I said a few minutes ago, that options are more frequently traded. So the option value or the premium fluctuates in price, and a long equity call, like we discussed earlier, is a bullish strategy. So the higher the underlying price goes, or the higher the XYZ moves, that premium will move higher on the option, and therefore you can sell to close the option at a higher price, generating a net profit. So yes, it does say you can exercise it, but most of the time people do trade the option to generate a profit from there because they don't really have the capital to purchase 100 shares of XYZ at $150 a share. That requires $15,000 worth of capital if they were to exercise. Okay, so on the left-hand side here, we have a P&L chart for this option strategy. We have 157 as a break-even price. Remember, I said this trade is bullish, and the 157 is a break-even because you have a strike price of 150, but you also paid $7 for that. So this strategy only becomes profitable at expiration when the stock is above 157. So this P&L chart is the value at expiration. And let's say if it was at 155, right? And let's say you exercised the option and you purchased 100 shares at 150. So by purchasing 100 shares at 150 and immediately selling it at the underlying price of 155, you generate a net profit of $5 a share. However, you paid $7 a share for this option contract. So therefore, you actually experience a net loss of $2 a share. That's why the break-even price is important. I would argue it's more important than the strike price because it tells you where the underlying actually needs to go to by expiration for you to be profitable. So gains begin above 157 at expiration, and losses are actually limited. That is a huge benefit of call options, is that when you purchase a call option, the max risk only occurs when the stock is below the strike price at expiration, and that is reflected by the premium that you receive. So you will not lose more than what you paid for this call option. And that max risk only occurs when the underlying stock is below the strike price of 150. Between 150 and 157 is when you still experience a loss, but a more limited loss, better than $7. Okay, so moving on to short equity calls. For short equity calls, it's simply the opposite of a long call option. In this case, you are selling to open a call option with an expiration date of July 7th, strike price of 150, and you're paying $7 for that. So it's simply the mirror opposite of what we just went through. In this case, you are obligated to sell 100 shares of XYZ at $150 per share at the buyer's discretion at any time up until the expiration date in exchange for a credit of $7 or 700 in total. So in this case, you are receiving $7. And remember, this is a bearish strategy because you don't want to be assigned, and you won't be assigned if the underlying is below the break even. Is below the strike price at expiration. So you want, if you sold a call option, you want price to be below the strike price of 150. That is why if it goes higher than that, this chart turns red because the losses begin at 157. So 157 is a break even because that is a premium you received and you add it onto the strike price. So think about the buffer between the strike price and the break even between 150 and 157. That is a $7 in premium. So that premium gives you a bit of a buffer. As long as the option expires with the underlying below 150, you will receive the max gain for the strategy. And that is simply reflected by the premium that you receive. So no matter what happens to the stock, no matter how low it moves, you will not receive more than $7 a share as your max reward. That is because the max reward, whenever you sell a call option or put option, is the premium that you receive. The break-even price is at 157. And again, that area between 150 and 157 is going to give you a profit, but a slightly reduced profit. So profits do reduce between 150 and 157 at expiration, assuming you do not get assigned. And the max risk here is, technically speaking, it is unlimited, because the stock can continue to rally to theoretically infinity above 157. Sorry, if you guys can just give me 1 minute here. Okay, apologies for that. I just had some technical difficulties there. Okay, so moving on to the strategy here itself, and really comparing between the two different, types of trades that you can do with a call option. You can either buy to open or you can sell to open a call option. So we have a very similar example of XYZ stock, and we are buying or selling a call option with an expiration date of July 7th, strike price of 150, and an option premium is currently worth $7. So that's how much the call option is worth. The price of XYZ, the actual market price, is currently at 150, and there's a 30-day time period. I use July 7th, but let's assume that's 30 days from now. There's a 30-day time period here to be profitable. So the long call purchaser is someone who is bullish on stock XYZ. They think the stock is going to move higher, and they therefore have, in this example, they think it's going to move to 165. That is their upside target. And like I said, they have 30 days. Therefore, they purchase one XYZ call option with a strike price of 150, expiring in 30 days from now. The short call writer, on the other hand, has the opposing view. He has a more of a neutral to maybe a bearish type stance on stock XYZ. 150 is a price target. He doesn't think it'll move higher than this. And again, 30-day time frame. So he will sell that same call option that the long call purchaser will buy, and therefore he will receive $7 per share in total, or 700 in total. Whereas a long call purchaser will receive, or will have to pay 700 in total. That's quite simple enough to understand. And let's say at day 15, the underlying stock actually rallies to $165 per share. So what happens here? Well, the value of the premium of the option will actually change, right? In this case, it's worth $17. And that can be calculated by looking at how far in the money that call option is. So this has a strike price of 150. Current price is 165. So the difference between there is $15, and that means that the option is in the money by $15, which also represents the intrinsic value. But it's currently worth $17, and that represents the extrinsic value, because at the end of the day, all options with time to expiration will have some extrinsic value. That extrinsic value will depreciate though, and that it is vulnerable to time decay. So as time goes on, that extra $2, assuming that the price stays at 165 up until expiration, that $17 will become $15, and it will reflect the intrinsic value of the option. Okay, so the long call purchaser in this case decides to sell to close that call option and receives $17. And this reflects a gain of $10 a share, because receiving 17 after purchasing for 7 gives you $10 per share in total, or a net profit of 1,000. As opposed to the short call writer here, they received $7. They therefore had to pay $17 to buy to close this position. And you normally see, short call or short calls or short put writers actually buy to close at around day 15 to avoid assignment. So in this case, they pay $17 to buy to close, and therefore experience a loss of $10 a share, or $1,000 in total. So clearly, the long call purchaser benefited from this bullish move in the underlying security. Now, let's say at expiration, the stock itself is at 166. So that means that the value of the option is now worth $16, And that is why, in this case, assuming that, they held until expiration, the long call purchaser would actually only receive $16 for selling this call option, as opposed to $17 in the previous slide, and therefore only receives a gain of $9 per share. So even when, until expiration, it actually moves a little bit higher by $1 a share, the long call purchaser was better off closing it at 15 days to expiration, because it had more extrinsic value, whereas now there's no more extrinsic value. Okay, the short call writer, that loss has now been reduced to $9 a share because, again, the value of the option did depreciate, or the extrinsic value of the option depreciated. Okay, moving on to another example here where, at day 15, so halfway through the time period for this trade, the option is the underlying stock is still trading at 150. So it's at break even. What happens here? Well, like I said, the value of the option is going to depreciate because of the extrinsic value components. When the stock is at 150, that represents all extrinsic value because it's worth $7, and it's $7 is extrinsic value. It's still at 150, but there's less time to expiration. So that extrinsic value will depreciate, and now it's only worth $5. 15 days to expiration, both investors decide to close their positions. The long call purchaser closes it for $5, reflecting a $500 credit, but a $2 loss per share, or $200 in total, because he paid $7 per share for it. And as for the option writer, he received $7 initially. He's now paying $5 to close it, and therefore receives a gain of $2 per share, or $200 total. So even if the stock didn't move, the short call writer was still benefiting from this neutral price action. That is a huge benefit for writing options, for writing calls and put options, is that the fact that they can benefit in neutral market conditions. And let's say in this example, the underlying stock XYZ at expiration is now at 145. In this case, the call option will have no value. It expires worthless. The long call purchaser, who had a bullish outlook on the stock, experiences a max loss of $7 a share, and the short call writer gets to keep the full premium received of $7 a share, and it expires worthless, so nothing needs to happen. Okay, taking a look here at long equity put options, and we're going to use pretty much the same example of a put option with a strike price of 150 expiring on July 7th for XYZ. So by buying a put option, you own the right to sell 100 shares of XYZ for 150 per share at any time up until July 7th in exchange for a debit of $7 per share, or $700 total. So this is the mirror image of a long call option. It is bearish, so the lower the underlying price moves, the lower the underlying price moves, the further green it'll be, up until zero. Obviously, the underlying price cannot decline below zero. And again, the strike price minus the premium received reflects the expiration, the break-even price. So even if, let's say, for example, XYZ is at 150, I decide I have a bearish view on XYZ, I purchase a put option with a strike price of 150. At expiration, it needs to be below 143 for that put option to be profitable, for it to be worth more than $8 or more than $7, which was a purchase price for the put option. So there is a break-even component, but again, this chart is only at expiration. And again, max loss occurs when the stock is above the strike price. It doesn't decline, and the max loss is simply the premium paid. Now, the short equity put option is a mirror image of the long put option, where, in this case, you are obligated to purchase 100 shares of XYZ for $150 a share at the buyer's discretion at any time up until July 7th in exchange for that $7 in premium per share, or $700 in total. So you would purchase the underlying shares. And if you were at my previous educational webinars, you'll actually know that by selling put options, it's actually a very cost-effective way to buy underlying shares that you actually want to own for the long term. However, we're not viewing it from that scope. We are viewing this as simply a naked put option. And the P&L chart doesn't take into consideration that you want to own the underlying shares. And for that reason, this is a neutral to bullish strategy. As the underlying price moves higher, the put option will depreciate in value, and therefore you can buy to close at a lower price than you sold to open, resulting in a net profit. So the strike price at 150, break even at 143. Again, you have to subtract the premium that you received. That creates a buffer. Losses begin below 143. And the max risk is quite significant here because it can decline all the way down to 0. So in this case, the max risk here would be at $143 per share. Break even again when the stock moves below the strike price minus a premium paid. And the max gain is simply limited to the premium that was paid to you. And that max gain is realized if the underlying price is above 150 at expiration or above the strike price at expiration. So going over to a similar comparison here, we have stock XYZ, and we have two different investors. One is a bearish investor, another one is a neutral to bullish investor. The bearish investor decides to buy a put option. He believes that the price will reach 135, and by buying put option, that gives him that bearish exposure that he needs. So he buys a put option, 150 strike, July 7th, and pays $7 in premium. And the short put writer has a more neutral to bullish view. He thinks the price will be above 150 or even near 155, and therefore sells a put option and receives $7 in premium, or 700 in total. On day 15, the underlying has now declined to 140. This means that the put option is now in the money by $10, and it's worth currently $11. So it's $10 worth of intrinsic value, $11 worth of extrinsic value. That extra $1 will depreciate as time goes on, or all else equal. Now at day 15, when XYZ is at 140, investor one, or the long put purchaser, decides to sell to close the option by selling it for $11 a share. He purchased it for $7 a share. This results in a gain of $4 per share, or 400 in total. On the other hand, the short put writer, after receiving $7 per share, has to now pay $11 a share, resulting in a loss of $4 per share in total. So naturally, that makes sense because the short put writer is neutral to bullish on the strategy, whereas it actually declined. Now at expiration, the price is now at 135. Therefore, there's no extrinsic value. It's all intrinsic value, and 150 minus 135 is $15. And that represents the current value of that call option. And here, the long put purchaser sells a put option for $15 a share, and therefore experiences a net profit of $8 per share. However, it's the opposite for the short put writer, who now has to pay even more, $15 per share, and therefore experiences a loss of $8 a share. Now, let's say at day 15 is at the break-even price. Now, the break-even price, you think, okay, they should both be, the value of the option should be at break-even. However, that's not actually the case because it's still day 15. There's more time to expiration, and therefore there'll be extrinsic value in the option. So it would not be worth, that $7. In this case, it's actually worth $9. So even though it's in the money by $7, it still has $2 worth of extrinsic value because of there's 15 days to expiration. And it's now worth $9. This case, even though the price is at the break-even price, or the theoretical break-even price at expiration, if the long put purchaser were to sell to close a position now, he would make a profit thanks to the extrinsic value component, resulting in a gain of $2 per share. And remember, for a short put writer or even a short call writer, the time decay works in favor of them because it depreciates the value of the option and it allows you to purchase it at a cheaper price eventually down the road. In this case, the short put writer would buy to close the put option for $9 a share and therefore has to pay $900 in total. This results in a net loss of $2 a share. So that's what happens. Even if price is at the break even, if there's still expiration, just know that the value of the option will still have some extrinsic value. Now, at expiration is at the break even price. This is, quite simply the fact, no extrinsic value, and the option value or the put value is still at $7, meaning both investors would close this trade break even. Now, let's say the underlying actually closes above 150 at expiration. In this case, the value of the put option, well, it has no value. It's out of the money, and therefore you cannot close the option. It simply expires worthless. The long put purchaser would experience a loss of $7 a share, which is the max loss of the trade, and the short put writer would gain $7 per share, or $700 in total, because it expires worthless, which is also the full premium received. Okay, so in summary, we have the 4 basic strategies. The long calls, these are purchased for premium. They allow for the right to buy the underlying shares. Time decay is negative. So time decay works against a long call holder. It reduces the value over time. And remember, your goal is to sell the call option for a higher price than what you bought it. And you can do that if the stock rallies more than the premium paid, especially by expiration. Generally, you'd want to have a long call if you think that there'll be a sharp upward movement. That is the best time for a long call option. For a short call option, on the other hand, this is sold for premium, obligated to sell the underlying. The option expires and you keep the maximum credits. That is the best outcome for this, for a short call. Time decay is a positive. It works in favor of the short call writer, and it profits from a neutral to downward movement. A short put, let's go for a long put first. A long put, purchase for premium, right to sell the underlying, and this profits when the stock declines more than the premium paid. Time decay is negative, because again, you like a long call, you want to be able to sell this put option for more than you bought it for, and profits from a sharp downward movement. And for short puts, it's sold for a premium and you're obligated to purchase the underlying shares. The best outcome for this is when the option expires and you keep the maximum credit. Time decay is positive, so it's working for you, and profits from a neutral to slightly upward movement. So with that, that is all I have for you today. And I'll open the floor to any questions that you may have. Please use the Q&A window. Thank you. Shouldn't we wait until after volatility crush after the Fed meeting before buying options? Great question. A little bit advanced for today's topic, Justin, but yes, you should. When it comes to buying, let's bring it back to basics. When it comes to the option premium, implied volatility does play a big part in the pricing formula. So what happens is before an earnings announcement or before the Fed meeting or something that's going to provide a lot of volatility in markets, implied volatility is high, and therefore the value of the options will be high. So it actually makes more sense selling an option than buying one because options are going to be quite expensive. Now, let's say, for example, that earnings announcement came out and the stock does not move 1 cent. It stays exactly where it is. The value of the option, though, will actually decline quite significantly because of the volatility crush. the earnings announcement is done, that implied volatility is less, and therefore the value of the option will climb despite the underlying price not moving at all. So when you have something like the Fed meeting today, and you have an interest rate announcement, implied volatility will be high across the board. Options will be quite expensive. And if you want to buy an option, it's best to wait until the Fed meeting is over, because it makes more sense to purchase cheaper options than expensive ones. Okay, I think that's the only question. Well, guys, thank you so much for joining me, and I hope you have a great remainder of the week. I will see you next week, Tuesday, for a market outlook. Until then.